Good day, colleagues, and thank you once again for joining us at this training session for the 10th call for proposals. I'm going to take you through the aspects of capturing financial information in the PIMP and just some things for you to be mindful of as you're capturing it. So the PIMP, I like to believe, is a representation of the plan and the theory of change in a budget and a plan or rollout plan over the life of the project. When captured well, one can really go through the PIMP and be able to translate it into a theory of change. So when it's done well, it's logical, it's clear, and it's easy to follow, and most importantly, monitor for ourselves, but also for you as the implementer. So the key things to be mindful of, I mean, there's lots of information in the PIMP itself, but I'll just highlight a few things, is that it is a cash-based tool. So entries, financial entries anyway, should be mapped based on actual movement of cash. In terms of the inflows, they are generally captured in the financing plan, which we'll go through in a little while. The outflows, which is the expenditure, the payments, are captured in this tab that's called the Activity Output Outcome Cost, which we'll call the AOOC. Thanks, Terence. The score summarizes or consolidates all that information in that it represents the inflows and the outflows, but it also tells us, gives us some additional information about surpluses. It also gives us, at the time of appraisal and even in monitoring, gives us some additional value for money metrics that we can track, we can negotiate, we can plan for as we implement the project. The funding allocation tab generally is a carry-through or should be a carry-through of your theory of change, and it just shows us how you plan to allocate the funding based on the funding gap that you've identified. We'll talk about that in a little while. So in this example, we're going to deal with how we cost activities in activity 1 of the ABC PIMP. Thank you to Mfundo, who set out the activities so clearly. The first one has to do with the advertising section, and in column in cell H16 to 17, we've been given some indication as to the units the units of advertising that we're going to utilize in that period. So when we move across to the financing section, we want to describe the activity in as much detail as possible, but no need for paragraphs. Sometimes we get PIMPs where the activity is a full paragraph. That's fine. It can be left to the far left of the PIMP. Here we just want one that's enough to give the information that's required to the reviewers. That's advertising cost. And so the next part, column AB, deals with the first level of categorization per our standard chart of accounts or score. And here you have a number of options, but the option to choose here is goods and services. Obviously, the finance people, and I mean it's just common sense, I guess, will find them easily, but otherwise go by a process of elimination, or you can just we'll flag it when we do the reviews. So goods and services is likely to have a whole host of other subcategories. So that's what I selected. And if I go across to the second level or the subcategory, sure enough, we have advertising, marketing, and communications. There are a number of other subcategories, and I guess as you're populating your PIMP, you also get to see what else is there so that you select the most appropriate category for your expenditure item. So there are calculations that I've placed here, and I encourage you to do the same, just so when we're reviewing again, we can follow, or we can agree that your logic is per the assumptions you've placed in the various cells. So this is just the total cost of the activity. We'll get now to how we got to that amount, where we deal with assumptions. So we've noted the units and the basis for the costing, and we also request that you provide us with a source of the assumption. So here, we assume that it will cost 20,000 to place an advert in Soweto Live, and 30,000 in the Citizen, and 3,000 for the Lohfelder. I think in the activity description they mentioned 2 in the Lohfelder, 1 in the Sowetan Live, and 2 in the Citizen. And that's basically what has been calculated in column AD16. And then if we go, and then if we're dealing with our assumptions, we want to see things about based on, what you've paid in the past, or if there's a quote that you've requested from the seller of the service. And when appraising, the appraisal team will request to have a look at those quotes. So preferably package it, upload it so they can refer to it. You can also refer us to those quotes in your assumption section here, or when you are interacting, they will request you for it. And this activity, obviously, it's a once-off activity. It's to do with the recruitment or the advertising at the early stage. So we do expect that it will be incurred and expended in the first period, July to September, i.e. paid. So as mentioned earlier, it is a cash-based PIMP. So we are expecting to pay in one of these months, and that's all it will be for that activity. So the second cost item is to do with activity 1.2, which is testing of the walk-in process as well as the online system. And if we go across to that particular item, it's exactly that. We are in the testing phase. We allocate that to capital, and under capital, there are a number of options. However, systems is the most appropriate selection to make. And here we've been told that the full quote for that phase is 100,000. However, they'll be required to pay 50% during testing and 50% on handover of the site. So we split that up exactly like that, 50% in period 1, which is when we're doing the testing, and we've just accounted for the handover of that system. Okay, so we continue with the costs associated with the activity. So here we are on activity 1.4, where Mfundo has told us that they're shortlisting candidates. They'll undergo aptitude tests that will be verbal and non-verbal. And then there are other further assumptions that also inform how we do costing. So if we go across, we said we've costed for staff time for the in-person assessment. We've also costed for telephony and data costs because some of it will be done online. We'll have to make appointments with the candidates, cancel, etc., etc. Here we have a new item, I suppose we haven't dealt with before. This is the compensation line, and here it is. If you look under, there are different categories of compensation. We have costs that are associated with existing staff in the company, in the entity, the applicants, new staff that will be hired because of this project, temporary staff that will be hired also to complete a specific task in this project. We have stipends and we have placements. But for this particular activity, we're dealing with salaries for new staff. And here, in terms of the units, we said they're going to hire 5 specialists, charge them at 100% of their cost. and they're paid 12,500 per month, but this is only for 2 weeks, and this is based on previous campaigns. So the point to note here is we want as much detail as possible to help us to arrive at the same place you arrived at when calculating the total cost. If you need to insert a new sheet, you may do so with the detailed calculations. And as much as possible, try and use hyperlinks, try and use references. We have asked you to upload budgets and models, and that will also obviously be helpful because that's the foundation of your costing. So you're welcome to insert those, but please guide us, because obviously we cannot be going into a model that has 14 sheets trying to figure out how one ties to the other. So the easier you make it for us, the easier we can get you as to where you've arrived at, and we can finalize it. So we continue along this vein until we finish costing for this particular activity. One thing I do want to note is that you will note that each activity is allocated 2 rows of costing per activity. It may happen that an activity has more than 2 rows. So for this particular activity, I think it is 1.6. I have 3 sets of costing that I need to note in the PIMP, or that I need to outline in the PIMP. And how you could be guided is that they have different subcategories. So if they're all under goods and services consultants, yes, you could layer costs and just provide us with the supporting sheet. But obviously you cannot group consultants with project management, etc., etc. So here I have a cost that kind of falls out of the 2-row allocation. So I've just had to tuck it in here on row 28, but I've specified that it's linked to 1.6 above. So it's not to do with the cost. It's not costing for 1.7. So please, would you do that for us so we can follow your budgeting easier. I want to deal with the in-kind match funding. So we were told that the company will provide in-kind match funding of 1 million in sanitizers, masks, stationery for our young work seekers, and the industrial psychologists. So this is just for illustrative purposes. It's not linked to any activity per se, but the one thing we ask is that you clearly denote where you're talking about in-kind costs, so it's easy to pick out. I've done that here. They all fall under goods and services. I've sub-allocated them, and these are the specific costs per the in-kind good or service, and here are the assumptions. And what we can do, because in-kind is not a cash item, we have to expense it in the activity outcome cost sheet, but we also have to recognize the income in the financing plan. So if you look at the financing plan under where it says non-cash contributions in kind, it's laid out as the income part of it is laid out as exactly as the expenditure part of it is. Our assumptions are there, and our breakdown per period is there. So whether you capture it first in the financing plan, the inflow or the outflow side, just when you do it the first time, copy it across into the other sheet so they mirror each other. That's your in-kind done. Great. Now we move over to the financing plan, which, as we discussed, is representation of the inflows to the project. It's got all the sub-elements of, potential inflows. Of course, the grant, which is what we're here for. It's also got matched funding contributions in the form of own contributions. From other sources, we heard that Vista Foundation is another contributor, and they contribute 50% of their funds in quarter three, which is quarter three of the government financial year. The government financial year runs from April to March, so quarter three will be the October to December quarter. So as you can see here, we've noted that 50% of that total allocation, and then the next 50% a year later, and their total allocation is 1.75 per the example. It's also loan financing in this case doesn't apply, but it's also made allocation for loan financing. As we discussed earlier, the non-cash in-kind contributions are also catered for. These have been set out based on the assumptions, and they add up to R1 million, as per the example. Here we don't have necessarily secondary cash flows, interest income. It might be that you hold cash because you have a delayed payment, etc., etc. Normally we don't see a lot of targeting for this, but of course when it does happen, we want you to report it in the actual reporting on the GMS. There are no service sales involved in this model, but that's also catered for. It could be in the form of placement fees, actual, crates of fruit, etc., etc. For the on-lending institutions and applicants, this will apply where you are expecting to get repayments from your beneficiaries, and PIMP will ask you to tell us what will happen to those repayments, which of course you'll capture on the expenditure side, or sometimes it just accumulates as a surplus. And then there's other earnings, and this is where you can put all other things that maybe we haven't thought about. So just to take you back to the primary flows, which is the grant and the match funding. Apologies for the Hadida. So we have modeled the grant and match funding. As you can see, it's not entirely, or it's not really on a one-to-one basis. This is because we've catered for the inflows here in these two periods, but also ideally, of course, you have buyers, or you have match funders, that are contributing funding in the manner that they're contributing. So outside of match funders wanting that have a set time and how they pay, set conditions, and how you draw down from the match funders, we suggest, or we recommend, that your drawdown, so your income, is closely aligned to the expenditure that you require. Of course, if you're borrowing money from an institution, this will ring, closer to home, because you're not going to draw down funds that you're going to be paying interest on. So ideally, draw the funds down based on what you require. So if you see here, we've only requested for 125,000 for the grant and 125,000 in match funding. Of course, the in-kind applies, it's needed anyway. And the reason is because if we go to our SCOA auto sum, we'll see that in that first quarter, our expenditure is 446,000, of which about 225 is cash. The rest of it is match funding. So that's all we really need the cash for. The rest of it is in-kind funding. So that's all we really need the cash for. So as a check, when you are doing your budgeting, just check in with the SCOA to see what your expenditure requirement is. And also the surplus, we have a surplus that first quarter, we also have an accumulated surplus. It also shows you how much kind of excess cash you may be sitting on. This is growing because I've just modeled the inflows for the rest of the periods in grant and match funding, and there's no concomitant expenditure, so it will show as as surplus. But once you input your expenditure, please follow this line closely to see what kinds of surpluses you're running. Of course, we don't expect you to be down to the bone on a quarter-to-quarter basis because things happen, but we will generally look at how you are utilizing the cash you're requesting before we release other tranches of cash. So if I go back to the financing plan, yeah, I think that's all explained. I'll move now to the funding allocation sheet, which is basically a way for us to see that, you know, the theory of change or the funding gap that you've presented to us is still being supported by the budget. For example, if you tell us that stipend costs are not being carried by the private sector, and or your funders, then we expect to see a lot of the grants carrying more stipend costs here, and the match funding carrying other aspects. So you align it to your agreement, you align it to the gap or the squeeze that you've experienced and the reason why you came to the jobs fund. There are certain things that we would prefer you carry, like existing staff compensation. No, you're already paying for that. Continue to pay for it. What we might negotiate with you on is if there's incremental allocations to that particular staff member of the project, but we don't want to see you bring your whole existing staff budget to the project because you're not necessarily showing us additionality, but also we're not necessarily risk sharing. You're just continuing to do what you have always been doing. A few checks have been built in, but before I go there, just want to say that we've tried to minimize the back and forth. So based on our experience, we've mapped the totals per SCOA subline item to the SCOA line. So for example, if you look at management costs, it's pulling from a SCOA line, and it is correct that we allocated 5,000 in our activity one to management fees, or fees that involve management oversight. The only two sections that will need to be put in manually are capital repayments and interest paid. Sorry, capital repayments and interest paid. And they will be shaded as such in the PIMP that you've received. Some checks for you to see whether you're on the right path. You'll see that the uses per the funding allocation sheet are tallied here, and you can also compare that to this line that tells you total expenditure per SCOA budget. So that's basically telling you whatever you've put in your SCOA budget, it's been duly pulled here, but also this is pulling direct from the SCOA budget. So here we're computing, here we're pulling direct. They agree. So that's fantastic. We also see that at the far end of the sheet, we have put in checks where it will throw out any errors. So here I have a check where it's pushing out, what is that? A training amount for 1 million. So it means that I need to go back and check why, because I have nothing allocated under training. However, I have placed something, I've placed 1 million rand under training. The culprit has been identified. So it was just to illustrate the whole funding gap narrative, to say that 1.75 million, I believe, yes, is coming from the match funder and the Vista Foundation. And in that case, suppose the match funder said we want to pay for training only and stipends. So what's happened here is that I haven't pulled it in, I haven't costed these things in the ABC PIMP, but when your funders are specific about things they want to contribute towards, please note them here. and it means that the balance is picked up by the jobs fund and the JFP or other funders based on either mandate fits or just risk sharing, whatever makes sense. But it should make sense. So that's the expenditure side of the funding allocation, and then of course, the income side should have all income sources, grant, match funding, and revenue. Yes, and other income, sorry, as well as in kind. So we'll now go to the score, and there are a number of things that I want to highlight here in the score. So first of all, you would see that I have circled the period 2 contribution. This is because, as I mentioned, in the in the financing plan, we weren't necessarily going on a one-to-one basis. We did so in the first period, the first quarter of implementation. However, the match funding ratio dipped. This is not something we'll necessarily accept when contracting. So when you see anything of these ratios look lower than what is contracted, it means you have to go back to your financing plan and correct it so that we are at least on a contracted basis. That's the least we'll accept. We won't go below that. So in this case, our JFP is a PTY, so they can't go below the 1:1, which is the requirement, and the problem is in this quarter. So they'll have to up their match funding contributions just to make sure that we meet the 1:1 ratio. They do correct it later on, but we needed to on a cumulative basis, and this is checking on a cumulative basis that our match funding ratio is intact. Another thing to highlight is that when calculating the match funding ratio, as when we're doing with eligibility, the in-kind isn't included. So this is looking at just the cash contribution. The in-kind is not included in our ratio, and it won't be considered when assessing your report to determine how much money we should be releasing. It's important to also note that whilst we have these budgeted and we've contracted to pay such amounts, we do check on a quarter-to-quarter basis performance, as I mentioned, for usage of the funds, correct usage of the funds. If there seems to be an accumulation or consistent accumulation of money, as in monies aren't being used, we might say to you, we're not necessarily going to release this 1.5 in this quarter because you don't seem to use it. So I think Mfundo mentioned, and you'll hear it many a time from us, make your budget and your plans as realistic as possible. Of course, we need everything to be done by this period, but do not budget in a way that's going to throw you off, say, from period 2. We don't like that. We submit budgets 3 years in advance. So we'd like for you, and of course, things change, we acknowledge that, but we'd like for you to please model as realistically as possible, especially because some of these things you have implemented before. And we won't necessarily give you cash just because it's budgeted for. There are other checks that we'll do before we release the funding. So the SCOA is the consolidation of the budget. We have the income aspect here, and then we come down to the expenditure, and the SCOA is reading from the expenditure side. Like I mentioned, it's reading from the AOC tab, and the income side is reading from the financing plan. So that happens. It's pulled things in. It computes your total. So this is a quarterly, it's always giving you a quarterly view, except where it does specifically say cumulative. So here we're looking at the cumulative surplus. And like we said, if you sat with 8 million rand in this quarter in period 4, and you still said to us, oh, please release the 1.5 we budgeted for in period 5. We'll say absolutely not. Can you show us that you're actually going to expend that 8 million plus 1.5 before we release it? We won't just release money into your account. But there is an opportunity cost, of course, and we can allocate it to others that have needs for the funds. So Mfundo has talked about the outcomes, and the score just lays them out again. As I mentioned for the appraisal section, but also just when we are sense checking and checking if we're being honest to each other, we are also going to check some value for money metrics. So, for example, if you are telling us that you are going to be eating into the grant a lot slower, than you'll be eating into your management costs, we might have a problem, Or if you're telling us that you'll be eating into the grant a lot faster than you deliver on your cost per job, we might have a problem. So it's just a way for us to, anyway, at the beginning, highlight risk. We might have a discussion with you about how to mitigate those risks. Some of you who have dealt with us before may be familiar with the term output-based, but yes, we know it's not the only way to mitigate risk, but it's a way for us to see how on the balance of things we have shared risk along throughout the implementation of the project. We do acknowledge that some models take a bit longer to deliver than others, but in general, we don't want to be upfronting money only to get to the end to see that it didn't work as we planned, because we'll have to account to people to say, yeah, what were you guys doing on a quarterly basis? So this is just for us to keep each other honest, to say what's happening with the rollout of the grant, the rollout of the jobs, the rollout of the cost items, because and we might have conversations before contracting, or we might put clauses at contracting. Of course, everything must balance. Here's our grant, our 10 million grant. Here's our 10 million cash match funding, 8.25 from OWN, 1.75 from the Vista Foundation. Here's our 1 million in kind, and then the expenditure will follow as you map it out. Then we have a few other tabs that are notable, just some summary. This is just for our internal use, but again, it's for you to check. It's another way to check if this is what you intended. And then we have our review tab, colleagues, which is where we'll document review questions for you. So as we are reviewing the PIMP, we will capture a comment. They'll give you a cell reference, the title of the person reviewing it, the date, and then we would like for you to respond as quickly as possible to the comments, and of course, make it easy for them to identify where it is you've made the changes, date, of course, and if we are not able to contact on time, we'll be following these closely to say how long after we loaded our review questions did you respond, and then the reviewer will indicate if it's resolved, if there's further issues. So there are a few iterations we expect this to go through, but we don't expect more than 4, as you can see. So hopefully we resolve all our issues by then. Thank you very much. We'll now go to the next segment as we continue on this training session. All the best.
Thank you very much, Eve. I really appreciate that. Colleagues, we are getting questions coming through on the chat. And I know that some of the questions are being responded to, but again, as we did in the last session, I would like to call on some of my colleagues just to reiterate some of our responses for some of the salient questions that are coming up, I think for the benefit of all of the participants in our conversation today. So let's start off, please, with a response to a question that relates to there being minimum values, project values that are expected by the Jobs Fund for this funding round. So the question more specifically was, does the Jobs Fund have or expect minimum project values for applications that are coming through? And associated with that question was whether the Jobs Fund prefers a specific cost per job ratio. So we'll start with the response on a minimum project values, and I'll ask Eve, please, just to respond to that one. And I'm just going to ask Mfundo to respond to whether the Jobs Fund prefers a particular cost per job ratio.
Thanks, Vuyo. So on the minimum values, it's going to be a bit of a long answer, but just bear with me. So if you're applying in the enterprise development or support for work seeker windows, the minimum project value should be 20 million if you are not an NGO, and 15 million if you are an NGO. That is because Jobs Fund will give you or can approve 10 million for your project, but require you to match on a one-to-one basis if you are not an NGO, which will take your project value to 20, or 1:0.5 if you are an NGO, which will take your project value to 15. If you're applying in the institutional capacity building window, the minimum grant size there is 5 million, which means as an NGO, your project size can be 7.5 million, of which you will provide the 2.5 and the Jobs Fund the 5. And if you're not an NGO, the minimum project size is 5 million, where we'll be matched again on a one-to-one basis. Thanks.
Great, thank you very much, Eve. And then in terms of the response on the preferred cost per job, the Jobs Fund does not have a preferred cost per job, but of course it is a competition, ladies and gentlemen. So to the extent that your proposed intervention is able to deliver direct jobs on a low cost, so in other words, where you are going for a low cost, a low barrier to entry, but high growth sector, that of course would be more competitive in the bigger scheme of things. So that is the response to that particular one. There's another set of questions, colleagues, that have come through that speak to the project start period, right? So some of the questions are saying that the template that we have provided, the ABC PIMP template that has been provided, has got a period one period or quarter, which is July to September. So there's a little bit of confusion there as to say, are we then insisting that all projects will start in July to the September period? I'm just going to ask that Mvundo please just respond to that, that question.
So if I lost you there a bit, I think my internet went out.
Okay, no problem. Let me respond to it then, Mvundo. So ladies and gentlemen, we've got a July to September period on the ABC PIMP, but that is just illustrative again. When your project period one commences is when the project has been approved and has been contracted. So if the project has been contracted by end of December, your period one will be January to March for 2023. So that July to September that we currently have there is just for illustration purposes only. I hope that clarifies. Then the next set of questions relate to in-kind contributions, right? So there are three parts to this that I would like us to tackle. So we're dealing with in-kind contributions, and the first part of this in-kind contribution conversation is about whether are in-kind contributions recognized as matched funding. So that's the first part. In-kind contributions recognized as match funding. The second part is, can these be accounted for, or how can applicants account for in-kind contributions on the SCOA? And then the third part is there a ratio for in-kind contributions that is preferred by the Jobs Fund? So let's go back then to responding to the first part of that, in-kind contributions. Are they recognized as match funding? If you could just respond to that, please, Eve.
Thanks again, Vuyo. So in-kind contributions may be brought into the project as they are, as it's often an important part of the project implementation. It's required to implement or to fully implement the project. So that's fine. However, at eligibility stage, in order to meet your minimum ratios, we will not consider in-kind. So when you're trying to get into the competition, you can, yes, we can conceive that there's in-kind, but it will not be counted as match funding for the eligibility stage. Similarly, when we are implementing, you may budget for the in-kind, etc., etc. When we are to release funding to you on a quarter-to-quarter basis, we will only look at the cash ratio. So again, if you say you budget to bring in a million rand cash for that quarter and 500,000 in kind, we will still look for the million rand in cash in the bank account before we release our portion. What were the other questions? Sorry, Vuyo, on in terms
no
of how
problem. Yeah, don't worry. I'll give you that now. How can in-kind contribution be accounted for on the SCOA budget? You did cover it, but I just thought let's just re-emphasize.
So as we said in the demo, in kind, you need to account for both on the income side, in the funding, in the financing plan. We have a section under C1, which is row, I just want to see the row quickly. If you go from row 47 in your finance plan, you can account for your in-kind on the income side. We also will ask that you expense it on the AOOC tab. Excuse me. So that's how you represent it. And then the SCOA will pull it all together.
Great, thank you. Thank you very much, Eve. And then the last question related to in-kind contribution is that, is there a preferred ratio for in-kind contributions by the jobs funds? In other words, a ratio of in-kind versus cash and so forth.
Mm-hmm. We only specify a ratio for the cash contribution. For in-kind, it's up to the project promoters as to how much in-kind you think is necessary for the project to succeed. We don't specify that.
Great. Thank you. Thank you very much. Now, the next set of questions relate to the treatment of foreign-owned entities. I'm going to ask Helena, who's also responded to some of these questions, please just to come through and reiterate the Jobs Fund position with regards to foreign-owned entities for this current funding round. Helena, over to you.
Thank you, Vu. Good afternoon, everyone. There was quite a few questions about that, so let's talk about it a bit. So if you are a foreign-owned entity, funding will not be available to finance your operations or grow your balance sheet. However, we will need to understand what the proposal is and what you intend to do in respect of job creation in South Africa. We would then need to look at how you intend to utilize the funds. If the funds are not deployed in South Africa for job creation, then we will not consider it. We would want to see how the foreign-owned businesses would empower local players in South Africa. So if it's an international company, but they've got a South African registered affiliation here, then obviously that can apply. So that I hope that answers the questions. I know Monica had a couple of them.
Great, thank you. Thank you very much, Helena. Eve, I see you've got your hand up. Would you like to add?
Thanks. I see a lot of questions coming through as in kind. I'm sorry, about in kind.
Yes.
So we accept, we accept services, we accept assets, we accept equipment, materials, sponsorships, we accept all those as in-kind contributions, colleagues, land, etc. However, it will not go towards the cash match funding contribution, and it will not be considered if that's what you're planning to provide in terms of that eligibility section, where we ask that you match us on a 1:1 or 1:2.5. So all those other forms can be brought into the project for implementation, for success, but not with eligibility. And in terms of supporting documents, it's anything that will help us to agree with you that the value that you are saying is worth is indeed what the market understands or conceives to be the value of that product or service. So quotes, timesheets, payroll information, valuation, all those things will support an in-kind contribution. Thanks.
Great. Thank you, Eve. And whilst you're on the floor, maybe you could just respond to one last question that relates to in-kind contributions. Constance asks the question, can timesheets and hourly rates be used as backup to support in-kind contribution values or amounts?
Yes, for resources, they absolutely can.
Great. Thank you very much, Eve. We'll now move on, ladies and gentlemen, to questions that relate to the management of the match funding ratio. Ben has responded to one of these questions. I'm just going to ask you, please, Ben, just to come in again and just give an overview of how we would want the match funding ratio. This is the ratio between what the Jobs Fund grant has been paid on a quarterly basis versus what would be the co-funding that would be submitted or paid over by the partner. Ben, do you want to just touch on that, please?
Thank you so much, Rio. Yes, so the minimum contracted match funding ratio should be provided every quarter. That's as a minimum, and the Jobs Fund partner, when approved, can put more match funding during the quarter, but we should always be at the minimum of the contracted or above. Thank you.
Thanks, Ben. Appreciate it. Okay, two last questions before we do have to move on, ladies and gentlemen. I'd like to ask my colleague, Catherine, to please come through to respond to questions, a question that relates to whether the Jobs Fund prefers to count just direct jobs, or do we also look into the improvements of livelihoods, for example, smallholder farmers and the like. Catherine, do you want to just come through, please, and just respond to that? I think my colleague Catherine has got challenges. All right. Let's respond to the question. So the question was, does the Jobs Fund look at only direct jobs, or do we also look at the improvements of livelihood? So there are two parts to the response. The first one is that, yes, projects are encouraged to submit proposals that are going to create jobs for participant beneficiaries. As this is a competition, of course, the more jobs that are direct jobs that can be created, the better off that project will be in terms of the competition. The Jobs Fund does also, however, recognize what we call project-specific indicators that would be looking at other aspects of development of the intervention, of development of beneficiaries through the intervention, such as the improvement of livelihoods of, as an example, smallholder farmers. So we do not limit it to jobs. Jobs make your project or your proposed intervention competitive for purposes of the funding round, but we do also measure other socioeconomic outcomes that are derived through the implementation of your intervention, such as improvement of livelihoods, etc. So that would be our response to that question. And there's the last question that I would like for us to tackle during this Q&A, ladies and gentlemen, and that is, can an impact fund apply to the Jobs Fund for the 10th funding round? If you could just respond to that one, please, Eve. It'll be quick.
They can.
Great. Thank you very much.
They can. We have no, I mean, apart from the operating and financial statement requirement, we have no limitations really on entities that can